Today on Forbes, New York City's proposed 9.5% real estate tax hike hits a national nerve. In New York City, property taxes are back in the headlines. Mayor Zohran Mamdani has floated the idea of raising them by 9.5% as part of this year's budget. Mamdani says it's a last resort, claiming that if Albany won't raise taxes on millionaires, the city may have to raise them on property instead. Property taxes have long been a political landmine because of their impact on household finances, including on your federal income tax return. Property taxes, more properly called real estate taxes, are local taxes imposed on real estate based on its assessed value and are primarily used to fund schools and other local government services, including sanitation, police and fire departments, parks, and street repairs. According to the Tax Foundation, in fiscal year 2022, property taxes accounted for 27.4% of total state and local tax collections in the United States, more than any other category of tax revenue. Local governments rely even more heavily on them. Property taxes accounted for 70.2% of local tax collections in fiscal year 2022. State and local governments favor property taxes because they provide a relatively steady income stream. The tax base doesn't move, and it rarely shrinks significantly. Houses and commercial properties don't relocate across state lines, and over time, property values tend to rise rather than fall. Every city or county has an assessor's office. Its job is to determine what your property is worth, typically what it would sell for in an ordinary market transaction. For houses and condos, that usually means reviewing comparable sales. What have similar properties sold for recently? For commercial buildings, assessors often rely on income data, including rents, expenses, and operating income. Once a value is determined, the tax rate is applied. The impact of property taxes also shows up on your federal income tax return. If you itemize deductions, you can deduct certain state and local taxes paid during the year, including property taxes. This is known as the state and local tax, or SALT, deduction, and applies to state and local income taxes, or alternatively, general sales taxes, plus real estate and personal property taxes that are based on assessed value. The deduction applies only to taxes actually paid during the year, and only if you are legally liable for them. You must own the property to deduct real estate taxes. Before 2017, there was no limit on your SALT deduction. If you paid $80,000 in real estate taxes, you could deduct $80,000. The Tax Cuts and Jobs Act changed that, capping the SALT deduction for both income and real estate taxes at just $10,000 per year, or $5,000 for married couples filing separately. That cap became a major issue in 2025 during negotiations among Republicans over their so-called One Big Beautiful Bill Act. Lawmakers from high-tax states pushed to raise the limit. A compromise vote has temporarily increased the cap to $40,000 for most filers in 2025, half that for married filing separately, with adjustments for inflation through 2029. The cap will drop back to $10,000 in 2030 unless Congress acts. Taxpayers care about the New York City proposal for the same reasons that many were focused on the SALT caps. Unlike more so-called invisible taxes, like sales tax, property taxes are visible. It's especially true in areas with rising property values, which can make housing feel unaffordable. Immediately after the pandemic, some states opted for property tax relief using budget surpluses. As revenue growth has slowed, holding onto or deepening those cuts becomes more difficult. Wyoming lawmakers, for example, are considering expanding property tax relief while exploring alternatives such as higher sales taxes to replace the revenue. But projections show that replacing property taxes entirely would leave a significant revenue gap. In Florida, where there is no individual income tax, Republican Governor Ron DeSantis has pushed to end property taxes, resulting in a slate of property tax reform proposals. Many of the bills have drawn pushback from local leaders, since without a replacement revenue stream, they may result in cuts to fire and emergency departments. And in Texas, which also doesn't have an individual income tax and relies heavily on property taxes, a $10 billion property tax relief package relies mostly on one-time surplus funds to make up the revenue school districts would lose. Once that surplus is gone, it's not clear how or if the state will replace lost property taxes. For full coverage, check out Kelly Phillips Erb's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.